Great, let's make a start. So welcome again, everybody. My name is Elizabeth To, and I'm the Senior Manager of Sustainability and Accounting at A4S. Thank you for joining our webinar today on debt finance. Please note that we are recording the webinar for others, and it will be made available on the A4S YouTube channel afterwards. So these monthly Sustainability in Action webinars are part of the A4S Academy, a program that is designed to empower and equip senior finance professionals with the skills that they need to succeed in the face of environmental and social risks and opportunities. And these webinars are open to academy and non-academy participants as well, so all are very welcome. So let's take a look at the agenda for today. So we will have a panel discussion with external speakers from Tesco and Moody's today, which is great. We really welcome our speakers. And then we'll have a Q&A session with the audience. And then I'll do a quick introduction to some A4S content, which will be useful for you, and then we will wrap up. So if you have any questions throughout the webinar, feel free to put them in the chat function. The learning objectives for today. So after completing today's webinar, you'll be able to describe how ESG risks are considered in debt finance decisions. You'll also be able to identify the benefits of implementing a sustainable finance framework, and also translate the experience and learnings of others on sustainable financing to your work. So you'll be asked a couple of questions about the content covered throughout the webinar using Zoom polls, which you will need to complete in order to get CPD or CPE points. So let me now introduce today's guest speakers. So we have Linda Haywood, Group Treasurer from Tesco, and also Alex Ashby, Head of Treasury Markets from Tesco as well. And we are very pleased also to have James Leeton, Senior Vice President, ESG and Climate Risk from Moody's Investors Service. So very warm welcome to our three speakers. And you'll also be hearing from the A4S team. So Helen Slinger, our Executive Director, and myself will be facilitating this webinar. So now let us find out a little bit about you in the audience. So we'll just run a few poll questions now. So you see on the screen, so which department are you from? Okay, great. So many of you are from finance, some from treasury, and some from sustainability as well. Thank you. Welcome to you all. And then there's also another poll question, should be coming up on your screen now. So to what extent does your organization currently integrate ESG factors into debt financing? Great, so I think many of you have started integrating some ESG into debt financing. But I guess, maybe just to a small extent. So hopefully you will find the experiences shared in the webinar today helpful for you. And just one last poll. So to what extent have you had discussions with your debt providers on ESG? Okay, so about half of you haven't had any discussions yet. So again, hopefully what you will hear from the speakers today will give you some tips on how to get started on that. And also you will hear from Moody's on some of the market trends as well, on what debt providers are looking for. So thank you for taking part in the polls. So now I'll pass over the time to Helen for the panel discussion.
Thank you, Elizabeth, and welcome everybody from me. So companies with the ability to transform capital from the financial markets into projects with tangible impact on the ground are in fact an essential part of the solution to delivering a sustainable economy. So many of you on the webinar today are from finance and from treasury, and the growth in sustainable finance in recent years can present some really interesting opportunities for you. Our speakers today can hopefully help you to reflect on your own companies and what opportunities you may have to do something similar. So on the panel today, we have James from Moody's, who will tell us about the latest global trends and developments in sustainable finance and how ESG factors are influencing fixed income investors' decision making. We also have Linda and Alex from the Treasury team at Tesco, who will tell us about how they are using sustainability linked financing to support Tesco's strategic sustainability commitments. That includes the issuance of their first sustainability linked bond back in January this year and their supply chain finance programme, which will launch in September. So welcome to the panel, everybody. I'm going to start with a couple of questions for each of you, just to give our audience an understanding of the context. Then we're going to delve a little more into the detail about the how. So what steps you've taken, both in the market and behind the scenes, to get you where you are today. And so just for our audience, as Elizabeth has mentioned, if you have any questions as we go, please pop them in the chat and we'll come to as many of those as we can. So James, if we can start with you, perhaps you can tell us a little bit about your role at Moody's and about the latest global trends you are seeing in sustainable finance in the fixed income market at the moment.
Sure, thanks Helen. So I sit within the regulated credit rating agency and lead our research and outreach efforts on ESG. And our primary objective is to be transparent and consistent about how we think and analyse ESG issues in relation to credit. We have other parts of the business which are focused on things like reviewing sustainable debt issuance and delivering specialist climate risk analysis, but we're getting a kind of broader suite of activities around sort of various ESG issues. And that means we're spending more and more time engaging with issuers around social and environmental issues as well, and discussing them in rating committees. So that's the day job, if you like, is how do we build this into our analysis, into our ratings, and that's something we're trying to capture more and more. It won't be ESG that's driving a rating in the majority of cases, but where it is, we want to flag that to the market and make that clear. So what that means is we're really focused on where ESG issues become material for the credit strength of an issuer, and that could be a government, a bank, a company, or a project. So we're rating the whole system, if you like, and all these different types of entity. So we're also looking at things like risk transfer and understanding how risk and opportunities are moving through the system, and different parts of it are affected obviously to different degrees. From the fixed income side, I think it is a bit behind the equity side on ESG still, but it is catching up. And I would note that this is not just about risk, but also the opportunity side. It's true that a lot of credit analysis is looking at the downside risk, but this is stretching our thinking to the upside as well. So companies that are well positioned to align with sustainability trends will then be rewarded in terms of how we view their credit strength. And maybe to give an example of that, we do look at things like the electrification of autos, and the sharp end of that is obviously car emissions targets in Europe and China, and companies that don't have a credible plan around that have been downgraded in recent years, Ford being a high profile example. But then we also look at the mining companies that are supplying the metals for the batteries, and that's obviously an opportunity for them to grow their business. The flip side of that obviously is in the oil sector, the mood music is not so good as it's eroding oil demand. So, this is where we're looking across sectors and making sure we're being consistent about how we think about things like the low carbon transition. I'd say that there are a lot of different approaches to ESG out there, and lots of different things that fall under ESG, and it's important to understand the difference there. There's growing concerns about greenwashing. So, for us, we're really looking at sort of two things. Firstly, the exposure of an issuer to ESG issues, and then we think about the mitigation measures that may be in place and how they're addressing those. And then ultimately, we're thinking, how does that impact the credit rating? I'd say that isn't a fixed formula or a kind of linear relationship. There's not a kind of a magic number that comes out of that. Really, it is case by case, and have a company in a sector that could be very affected by ESG issues, and then its peer maybe not so much. So we are trying to get down to that level of differentiation, because there are always overriding credit factors as well. It could be liquidity, it could be because it's owned by a government. So we have to understand where that sits in the kind of hierarchy of credit factors.
Right. And I think what's really interesting to hear there is it's not just about downside risk, it is also obviously the opportunities there are as well. Okay, so James, I understand you've recently published an insights piece on the sustainability linked bond, or the SLB market. In a moment, obviously, we're going to hear from Linda and Alex representing Tesco as an issuer, that they'll talk about their sustainability linked financing. So maybe you can tell us a little bit about, more specifically about that SLB market, the trends that you're seeing, and what the implications are for issuers such as Tesco.
Sure. I mean, sort of bigger picture, we track the sort of full range of green and sustainability debt instruments, and the first quarter is really strong this year, around 230 billion in total, and of that, SLBs were a relatively small but definitely growing piece of the pie, around 8.6 billion in the first quarter, primarily coming out of Europe. I think the launch of ICMA's SLB principles last year has helped clarify the market and give a structure to it. So that's certainly going to help drive this kind of facility, which has obviously some broad appeal to corporates who are looking to have a general push on these issues. And that's what's interesting for us, is it's you can link it to the broader strategy of the company, which is what we're thinking about. This has to go beyond sort of good housekeeping. It's what does this company do in terms of its fundamental business. So that's what the targets need to get at, is the most material part of the value chain. I think we've also seen social issues rising up the agenda, and some financial players, for example, have issued social bonds in order to finance investment in enterprises that have strong empowerment of women or are aiming to address inequality. So there's definitely strong interest in the market about getting more exposure to those kind of solutions. And I think in all of this, that we need to be clear about what investors want from these instruments. So do they want to see the impact measured? Do they want to see additional impact? Do they want to see both of those things? And that's really, where there's some confusion, I think, in the market around different ESG products, because a product can be created for one sort of solution, and then it's being assessed against some other sort of purpose. So that's creating a bit of the confusion. Not all ESG analysis is designed to create alpha, for example. So therefore, it's not a reasonable test to expect that as an outcome. And you get biases from the geography or scale or sector, from different funds and benchmarks that you need to allow for. For example, if you're assessing disclosure as part of your measures, then that is going to bias you towards large Western companies, for example. So I think all of this means we need to dig a bit deeper underneath what's being put out from the companies, and the selection of targets is really important. There we want to see a level of ambition. Is this taking the company beyond where it would have gone otherwise? And then the other important element is obviously the science, and that's a key aspect of credibility. And for us, that needs to be positioned in the context of the company. Where's it starting from? Which markets does it operate in? Not all companies are starting from the same position in their sustainability journey, and not all are going to be exposed to the same risks, if they don't follow the sector trajectory. So that's where we're probably applying a bit more of our kind of analyst knowledge of the company from our engagement with them, in terms of where we think companies should be and where they should be heading for. It's not necessarily a sort of one size fits all in that sense. But certainly having metrics that are consistent and comparable is useful and enhances transparency. I think if you have to come up with something that's so complicated and convoluted that it takes hours to work out what it means, then it's probably going to raise more questions than give answers.
Thanks, James. It's really useful to sort of hear how credit rating agencies are looking at this debt raising, and indeed how that's changing over the course of time. So we're starting to see some questions coming in from our audience, but actually long before we come to them, we've got a question for our audience. Hopefully, if my colleagues can just pop that on the screen for us. So within your organisations now, we've obviously got a few treasurers on the call and lots of people from wider finance. So which of these drivers in your organisations are most likely to influence your decision about whether to consider sustainability linked bonds? There's a few different options there, some of which we've already touched on. Okay. You can see those on the screen. So maybe if we just leave those on the screen for a moment, because Linda, I'm going to come to you. It looks like the most popular response is around tying KPIs that are relevant and material to the company's business and sustainability strategy. So my question for you is to what extent does that resonate with Tesco and your scenario and some of those different answers that we've got there? And I guess why was it important for Tesco to launch this sustainability linked financing? Do these responses resonate with you?
Yeah, no, they absolutely do. I mean, I think it's really important, and to me probably the most important thing when you're looking at sustainability linked financing is to link it clearly and obviously to the company's underlying strategy. So we publish something annually that is the Little Helps plan that sets out our sustainability strategy, and that very much was the springboard for our sustainability linked bond. And actually our sustainability linked bond framework, financing framework, is completely based on what is in the Little Helps plan in terms of the areas of focus and the targets that we've linked our bond to. So absolutely it resonates. It's like the first step, if you like, is to understand the corporate strategy and put the financing around that rather than vice versa.
Can you give a little bit more detail perhaps about the bond itself? I guess in terms of not just the background to it, obviously, but actually what it was that you issued and how it's linked to sustainability performance.
Yeah, so let me start with a little bit of background. So the bond we issued was the second step in our programme to link our financing to our environmental strategy. We've got a well-established strategy, and greenhouse gas emissions being the most embedded in that, where we were the first corporate to set science-based targets in 2017 against a 1.5 degree trajectory. And the first thing we did in August last year was that we refinanced our revolving credit facility with KPIs linked to our greenhouse gas emissions, renewable energy, and UK food waste. And then that led quite neatly, because I'll come on to tell you a bit later on about how we went about doing that internally, but it formed the basis really of us then starting to look at the sustainability linked bond, which I'm going to call SLB from now on, because it's a bit of a mouthful. But that was the next step on our journey to embed that strategy into our financing. And we liked the flexibility of an SLB, which is general corporate purposes bond, rather than a green bond or use of proceeds, because it reflects more holistically against our business strategy. So we thought it means that debt investors look at you in a similar way to equity investors, which we liked, and we liked that read across. So as Helen mentioned earlier, we launched our bond in January this year. It is a 750 million euro, 8.5-year bond. And at the time, we also concurrently launched a multi-currency liability management exercise. So in effect, we used the proceeds from the bonds to buy back some longer dated bonds in our debt portfolio. It was the first SLB this year, the first from a UK corporate and the first from a retailer globally. So it got some attention and a lot of investor interest as a result. It was linked, so the KPI in our bond, whereas we had 3 KPIs for our revolving credit facility, we actually linked this to one KPI, which is our greenhouse gas emissions target to reduce scope 1 and 2 greenhouse gas emissions compared to a 2015 baseline by 60% by 2025. And that meant that we could then have a coupon step up should we not meet that 2025 target, which will impact the bond from 2027 onwards. The whole bond was structured, and the way we marketed it was structured to align to the ICMA sustainability linked bond principles, and we got a second party opinion from Sustainalytics on that. And the framework and the second party opinion are all public. They're on our website, so it's possible to go on and view those and get a bit more insight into how we went about structuring those documents.
Great, thank you very much. A lot of information in there, but really, really useful. Thank you for sharing that detail. So, Alex, obviously, you know, busy in the Treasury Department at Tesco. It's not just been about the SLB. You have been working on the other side of things. So whilst the Sustainability Linked Bond, the SLB, I'll go with the acronym, has been focusing almost on that, the internal side of things, you know, what Tesco are doing internally. You're looking outwardly, more at that side of scope 3 type things, and looking at the supply chain finance programme. So really keen to hear about what you've been doing on your supply chain finance. And I guess a really interesting point for me, and certainly for many that are listening who are just joining the A4S Academy, this actually formed part of your Academy implementation plan. So sort of great to see how you've taken this forward. So I guess my first question is just as giving a little bit of that context. You know, what is, when you talk about supply chain finance, what is it that you are actually referring to? Just sort of get a common sense on the call that people understand where you're coming from.
Of course, thank you, Helen. Yeah, and great to be here. So yeah, just to start at the beginning. So supply chain finance is a means where our suppliers, Tesco suppliers, can get paid early on their invoices. It's completely voluntary. People can sign up if they want to. It's something we offer as a service offering for the supply base. And the financing is provided by our relationship banks, and they're able to look through the invoice and price the financing at a cost of funding commensurate to where Tesco would fund. So it's nice and cheap for some suppliers, but not perfect for all. Some may want it, some may not. So it's a totally optional offering, allowing people, you know, to get funded cheaply without a change to any commercial terms or any benefit to Tesco. it's just something we do, and it's very, very common in retail. Most retailers offer it, and most FMCGs, fast-moving consumer goods companies, offer it as well. In terms of what we've done here, I mean, most sustainability-linked financing products do all work the same way. There is a pricing grid and an assessment, and in essence, what we've done here is we've created 3 reward tiers where people are able to get an improved rate, which is assessed annually with an initial focus on climate, which is our planet pillar of the Little Helps plan that Linda introduced earlier. But the plan is over time to evolve those KPIs in line with market standards, and also in line with our own plan, and then include other things outside just climate. So we're going to go broader and look at, for example, marine forestry. Obviously, we will get the balance right. You can't have too many suppliers. I know there's a question to come, but you know, one has to balance really carefully the credibility point and how much effort and work it is for suppliers to complete to get the benefits.
So why did it come about? You know, what were the drivers in terms of putting this in place and linking it back to sustainability?
Sure, it's a great question. I mean, ultimately, we started this journey a very, very long time ago. But I mean, the most recent drivers really, I mean, have been the WWF partnership, where we've been really looking as an organisation at food. You know, the WWF did a huge piece of analysis looking at drivers of carbon emissions globally, and the food supply chain was by far the largest. So, you know, and that's where the sort of the partnership with Tesco came from. Obviously, as a UK charity who would want to work with to tackle food emissions, I think Tesco would probably come up the list pretty quickly. So, you know, that was really the start of the thinking, and this is aligned very well to our overall sustainability agenda. I mean, ultimately, it encourages suppliers to continue or start their own climate journeys. You know, it's not just about rewarding people that are already there. It's about finding ways to encourage people to start on that journey that haven't quite got there for whatever reason. They might be small, they might be medium, they might not have got their boards convinced about it yet. Ultimately, this gives you know, a funding benefit. There aren't a huge number of benefits out there outside financing we're aware of that enable people to kind of actually justify the investment in some of these activities. So it's a great offering from that respect. And it's also quite nice that involves our bank group, who are all very interested to understand our supply base, and it may mean that they're able to then work with suppliers as well through other bank products around this offering as well, which would be a nice ancillary benefit for our suppliers.
Fantastic, thanks, Alex. So we've taken us through a little bit of the, what you've done and why you've done it. Before we come to the how in a bit more detail, perhaps, James, we can just reflect back with you on the greenhouse gas side of things, the carbon emissions, and if you can tell us a little bit about what you're seeing in the market related to the trend around net zero and climate disclosure under TCFD and similar.
Sure, thanks, Alan. We're seeing a growing matrix of targets and policies across governments, investors, banks, corporates, particularly this year with around net zero. And that makes it increasingly hard, for anyone to operate without being touched by efforts to decarbonize. And that greater transparency that's being required for the portfolios of banks and funds and insurers in Europe, that's not only going to affect, the European operators, if you like, but their supply chains, but their international operations. So it's going to have some global reach. And there are other measures, being proposed, such as green asset ratios for banks, which could change the dynamic there in terms of capital requirements. The Bank of England's currently looking at how to green its own portfolio. So, there's really a kind of full court press in terms of, this is not just a specific thing about how you regulate emissions themselves. It's how do you weave this through the financial system to make sure it's aligned with the targets that we want to achieve around emissions. And it seems like the US administration is also minded to align with Europe, which could result then in having, two major financial markets driving those international standards, and that would have a much broader sanitizing effect on exposure to high carbon activities. We've already seen, challenges at the margins, if you like, to refinance or insure coal projects, but you could see that spreading further, particularly given, the things like we've seen from the IEA sort of indicating that no further coal, oil or gas development is needed to align with net zero. That raises a fundamental question about how financial institutions engage with players in the extractive sector, for example. In terms of how we think about this, then we like to understand the context of operators. So not all sectors and regions will move at the same speed, even within some of these scenarios. So that's what we're looking in our carbon transition assessment approach. The strength we bring there is understanding what companies do and where they do it, and combining the kind of economic analysis and how markets work with the climate analysis and understanding. So that's really, where we see carbon transition translating into credit risk and starting to affect the cost of capital, because it's really starting to sort of squeeze the potential future, even for gas, in Europe and the US, if you're going to get down to that level of low carbon power, for example, then it really doesn't allow any further growth of gas, which has obviously long been talked about as a transition fuel, but that window is definitely closing in some markets. A lot of the net zero targets are obviously quite long dated and decades away, which is, several CEOs or presidents or prime ministers away. But, if you look at the UN guidance on what a credible net zero target is, it makes it clear that the first step is a key part of that. And, that's, an area we're definitely focused on is, well, can we see that first step, that commitment, that allocation of capital to start redirecting enterprises? So, that for us is something that we can definitely see as, a key component of our analysis, because you can link it to credit and say, well, whether it's, electric vehicles, you can't make those overnight. You have to commit the capital several years in advance to come up with a new product and scale it up. So, that's what we're seeing, even though the target may be 2025 or 2030, is the investment being made now to deliver that.
So the momentum is in full swing and is definitely here to stay. Fantastic.
Yeah, this is where this kind of finance is helping.
Yeah, absolutely. Great. So we're going to have a quick poll back for our audience. If we can maybe get that on the screen. Just a little bit of a check back on everybody. Make sure you've been listening. For those of you who want some CPD points. What are the current trends in sustainable finance in relation to the fixed income market? A few responses there. Give you a moment or two to take a look. So as we can see there, we've got responses against each of those areas. Now, actually, the top 4 we have touched on, and they are reflective of the current trends. The bottom one actually is something of a myth, but it is something that it definitely has some traction out there. But it is indeed, there is actually quite a lot of evidence to indicate that this isn't the case. So there's plenty of research which highlights that the incorporation of ESG factors can potentially lead to better performance. Not only that, there's strong empirical evidence that shows that a positive relationship between ESG and financial performance. And the structural relationship between ESG credentials and companies help investors to assess future profitability and business risks of individual companies, which is consistent with a lot of what James has been referring to earlier. Great, so let's come back to a little bit of the detail of what you've been up to at Tesco. Linda, can you maybe tell us a little about the journey you went on to develop your SLB framework and to launch that first bond? You know, who did you work with? What were the key elements? Those sorts of things.
Yeah, well, I think the first thing to mention, and probably I'll keep coming back to this, was to engage our internal stakeholders, particularly in our environment, CSR and responsible sourcing teams, all of whom have a role to play in our environmental strategy. They, if you like, own our Little Helps plan, and so we needed to work very closely with them, and that's something that you might not typically do as a Treasury team if you are not involved in sustainability at all. I mean, we are actually on several fronts involved in it, so we knew them before, but this took that collaboration to another level, I would say, and I think, you know, Alex will add to this, but he's taken it to another level again. So the framework that we put together builds on our Little Helps plan. As I said before, it was really critical that it aligned to our corporate strategy, and we wanted to choose KPIs that were critical environmentally, were well established, and also were externally assured, so that investors had that reassurance that what we were doing and the results we put out, which are put out every year in our Little Helps plan, were reliable. In terms of structuring the bond, aside from the sustainability angle, it was pretty vanilla. We choose, as we always do, currency and tenor to maximize the positive economics of the transaction to fit with our debt maturity profile. And then this time the addition was to align to our sustainability and specifically to our greenhouse gas KPI. So that was put together in the background during, we were in a closed period over Christmas. As soon as our Q1 and Christmas trading update came out in January, we were investor marketing. So we did a day of investor marketing, starting with a global investor call, which our CFO hosted. And then we did a whole series, a whole day, actually back-to-back, one-to-one investor briefings. And in that, we included one of our sustainability team, as well as someone from IR. And because, as you would expect, most of the questions were about the sustainability link and where we were on our trajectory, how we were going to meet our targets, and various other questions that investor had. So there was a lot of engagement before we actually launched the bond.
Fantastic, thank you. And Alex, over your side of the Treasury team, you know, you're working presumably with both internal and external parties in the supply chain program. So how did you go about doing that? What were the different things that you had to, the different parts you had to put in place?
Sure, thanks, Helen. Yeah, well, very similar stakeholders to Linda. Obviously, we've got a very solid relationship through all these activities, which goes back quite a few years now with the various teams involved in sponsorship. But yeah, I mean, this angle, because it's kind of got an IT platform element to it. You know, we did a global RFP and went out to the market to see what offerings there were. We selected Santander as one of our relationship banks to actually deliver the overall IT and interfacing and infrastructure behind the platform. But while we were doing that, we've engaged with our bank group. We've got over 10 banks willing to fund it as well to make sure there's capacity to scale. And ultimately, we also looked at how we could come about this sustainability assessment, and ultimately we chose to do a proprietary measure where Tesco measure in line with the Little Helps plan. I mean, there are other options out there. You can go and in essence sort of buy someone's rating model. I'm sure people are aware of Sustainalytics or EcoVadis or other names in that space. So we met with a number of providers there, but in the end we decided it was more appropriate for us to go with something aligned with what we wanted to deliver there. And finally, as well, we've also worked with KPMG, who are going to provide some annual limited assurance in the programme. That's not required, but we're very much trying to, I guess, by being UK first, encourage and really kickstart this this product, and really hopefully get some notice from banks and regulators for others to follow suit in supply chains to carry on where we've started.
Thank you. And I might just come back to you anyway, Alex, because we've got a question from the audience. Just looking at what you put in place in your supply chain. And I know that when we've discussed this previously as part of the Academy programme, you've shared a little bit about, how you change the requirements of the suppliers dependent on size to make it accessible for everybody, and so that it's not an overburden and from an administrative perspective. So perhaps you can share just a little bit in that regard as well.
Yeah, sure. And thanks for the question, Fiona, if that's the first one. So ultimately, Helen's absolutely right. So the press release didn't obviously have all the detail in the world. It had, a number of things that were not included. And as Helen says, we absolutely challenged ourselves to understand that balance between small suppliers. And, we were always trying to really think through the lens of an SME and think, right, is this going to be too onerous for them or not? So we've got a segmented approach where there's less questions and less asks on smaller suppliers. So we've aligned this to how we define how we bucket up suppliers internally. So very much already thought through that, and actually there's a minimum threshold, but we have adapted the ask to be less onerous for smaller suppliers. And similarly, I mean, the whole offering here is voluntary ultimately. However, we have not made the sustainability element voluntary. The financing is voluntary, but the problem is if you make this sustainability thing voluntary, those that may not perform well won't do it, if that makes sense, and those that will. So I really can't see how it would work if you made the whole thing voluntary. We do appreciate it, will be a burden, but it's an annual update. We provided an awful lot of materials. We actually have a whole portal called the Tesco Supply Network, which has got links to carbon calculators, advice, guidance, all manner of tools and materials for suppliers to use. That's been around for a few years, and we've actually massively invested in around the launch of this program to further enhance that. And similarly, we've also actually got a sustainability consultancy and Thesis who are helping with a bit of the methodology work, and they're going to be on hand as well to help suppliers with any questions they may have when completing it. So I do hopefully we have invested, that might not have got out, but that is absolutely what we're doing, and that's the focus for the next few months.
Great, thanks, Alex. I'm afraid it looks like you're in the hot seat. Most of the questions coming in are for you. So we have a question here from Sam, who I believe is also in the retail sector. So perhaps you've inspired her to do something similar. But asking about the demand, the interest and the engagement from your suppliers, what does that look like so far, and how involved were those suppliers in shaping this approach?
Great question. Yeah, so I mean, in terms of how we've managed this with suppliers, we absolutely tested this on quite a few. We deliberately went out to SMEs, to medium corps, larger corps, and asked for guidance and so on. I think we talked to over about 12 meetings or so in the run up to this across those segments to really get the feedback and input from it. So overall, I mean, the demand and interest has been fantastic. We're actually currently trying to work through the current suppliers on the scheme. There's around 200 currently. We've already got a waiting list of suppliers that are really keen to get involved. Obviously, we need to do right by those and do them first, but there's a big waiting list already. And actually, to be honest, even in the product itself, I know Santander have shared with me that they've actually had a number of retailers come and follow suit and ask for guidance, input, and apparently most RFPs in this space now include this angle. So it's very much, I guess, on trend and coming in terms of how it's coming through. But yeah, in terms of our suppliers, it's been fantastic so far. Really good feedback. I even had one of the founders of one of our sort of incubator suppliers say that it was a fantastic idea, and he wanted to roll it out to as many B Corps which he's involved in as possible. So, you know, in terms of reception, it's been pretty great.
Thanks, Alex. And I think I'll give you a little bit of a break and come to James. So I have a question for you, James, from Manuel. What other types of SLB are you seeing linked with KPIs other than greenhouse gas emissions reductions, perhaps? You know, are these attractive, and what are the barriers that there are in place? Not in place, but what are the barriers?
Yeah, I mean, certainly greenhouse gas, I think, is dominating the sort of renewable energy or waste management or water. A few on the social side, you know, community involvement or gender. But yeah, I think it's still sort of developing in that sense in terms of what people are using. But, you know, as we said earlier, I think if you're bringing it back to the sort of strategy of the company, then it should be something that you can measure in that sense. So whilst I think certainly on the social side, there is this sort of perception of a barrier that it's harder to measure or it's harder to monitor. But I think if it's that core to your business, then obviously it's something you should be able to track, and that's sort of where we're looking for the kind of action, if you like. So yeah, I think it's probably a bit early to say, you know, this is the model or this is you know, a clear trend. So yeah, interested to hear what ideas people have.
Thank you, James. And I think one thing that resonated with me earlier that Linda was talking about is she was talking about they wanted to not just link to their projects, they actually wanted financing that covered the whole organisation. You know, from your perspective, you know, is there a difference there, you know, when you're looking at the credit side of things and when you're looking, you know, in terms of your perception of the trends, you know, how important is that? Do investors have different views about those different elements?
Yeah, I mean, there's obviously different types of investors. I mean, for us, we kind of say, well, we've always talked to companies about strategy, so this is not anything different, and it should be part of our conversation. I think the kind of the sort of double materiality of it, if you like, of what's the impact of it, is the sort of related part, and that's obviously the bit that we're also trying to get to with these type of instrument. So I think that's where it's a bit more challenging, but certainly, you know, it's something that there's more focus on now and more support, as we've heard, to get these types of instruments going. So you know, it's I think the conversations we're having are also around, you know, where does this move the needle? Because if you've made a commitment to net zero, we're not going to achieve that by incremental, you know, being a bit more efficient. So I think that's sort of the ambition level of the discussion, if you like, of, well, actually, you're going to have to put something fundamental on the table. It can't just be doing things a little bit better.
Great, thank you. And Alex, I've given you a little break now. We have another question for you. Can you give an example or give different examples of the types of climate targets that are set for your suppliers, and how do they access the different reward tiers within that supply chain finance?
Sure, yeah, happy to. It's more a principles approach. It might be one I'm happy to take offline if people want more detail, but I'll talk a little bit. I don't want to take too much time. But I mean, ultimately, we followed quite a standard methodology to set it. I mean, as James already talked through earlier, you know, there's a lot of stuff out there. I think environment is more developed. You know, there are good practices. We followed the greenhouse gas protocol. We've linked it with kind of science-based targets and so on, and tried to follow what's already out there and try to keep it as standard as possible so suppliers already have or understand what we're talking about. But in terms of how we're assessing it, you know, it is hard. Every business is different. So we've got a pilot methodology. We're going to be refining that once we've worked it through with the current 200 suppliers in the program. But the high level tiering we've got is kind of goes from bronze to silver to gold. So bronze, we've got someone who's at the point of understanding their impact. You know, have they made that effort? Have they really assessed what their impacts are on the environment? Silver having targets, and then gold demonstrating meaningful action from there. So obviously there's a huge all manner of different KPIs under those, but those are kind of the headlines of how we see it. And the idea is hopefully those move going forwards. The idea is if we can encourage someone to come in at bronze and actually start understanding their impact, the obvious next step would then be setting targets and then finally delivering on those targets. So I think those are quite logical in terms of thresholds. We do have some percentages and guide rails for that, but probably not the forum to share, but happy to share offline if those are people are interested. Just please follow up with me through the Academy or otherwise, and I'll gladly share offline.
Fantastic, thank you, Alex. And one final question for you, Linda. So people on the call, if they are looking at starting this journey, they're looking at their first SLB, what would be your top advice, your top tips for them to get started?
I would start looking internally, actually, and look at what the corporate strategy is and who is driving that. I mean, obviously it's being driven by the exec team and the board, but who internally are your partners on setting up a sustainability linked financing framework. And it will be the people who understand what the corporate strategy is and are driving that and understand what the targets are and what they mean, and start an active discussion with them to understand what's possible and what the key things are and what the key drivers are. On the flip side of that, you need to talk to your banks. Whoever's advising on debt capital markets generally will have a good handle on the SLB market, and get some advice from them on what the current trends are. I mean, I think what James said resonated. This is all evolving. We expect our framework to evolve over time and pick up more of our KPIs. And I think, it doesn't have to be greenhouse gases if that isn't important to you as a corporate. It can be another KPI that's important. But the thing is to have credible targets that are measurable, that are being assured by a third party, so that you can really stand behind them and say, I'm issuing this bond and I really believe I'm going to meet these targets. And I think that having that level of confidence when you come to talk to investors plays a really big part. I guess the flip side of involving internal stakeholders as well is it actually helps their understanding. Our internal stakeholders have really enjoyed understanding how this flips into financing. It gives it a different lens. It gives it a different measure of importance to the ones that they're used to, because suddenly you've got a real piece of debt paper out there that depends on this KPI. And so, if you like, it's a two-way collaboration in that regard. So that's definitely where I'd start. I'd start internally, start with understanding corporate strategy around sustainability, and then layer that through with your debt advisors and your bankers, to work out how to structure something.
Fantastic, thank you. And thank you to all three of you. I think that's been a fantastically insightful session. And thanks again, Alex, for the sort of follow-up comment there of you'll be happy to make yourself available to Academy participants who can find you through the Academy platform. So thank you very much to all of you. Elizabeth, I'll just hand back to you to take us through the last session.
Thanks, Helen. So I'm sure many of you are feeling very inspired by what you've just heard from our speakers today and want to get started or maybe further develop your work on embedding environmental and social considerations into your financing decisions. So let me just briefly introduce you to two A4S resources which can help you. So the first one is the A4S Essential Guide to Debt Finance, which includes an introduction on why considering sustainability is important for treasurers, and it also gives you perspectives from both debt providers and issuers based on interviews that we conducted with them. And the guide also gives you tips and guidance on how to integrate sustainability into Treasury team activities and for engaging with your debt providers on sustainability factors. And there are also a number of case studies within the guide so you can see how companies are doing it in practice. The guide has been created by Treasury teams for Treasury teams, so do take a look, and the link to the guide will be sent to you in a follow-up email afterwards. And the other resource is the top tips for Treasury teams on implementing a sustainable finance framework, which was published last year. And it was developed again based on the experience and insights from members of the A4S CFO Leadership Network, who have been putting in place sustainable finance frameworks and issuing sustainability-related financial instruments in the market, such as sustainability or green bonds. And the top tips offer a really good starting point for treasurers who are beginning to consider sustainable finance, and companies where perhaps sustainability might not yet be fully embedded into the business strategy. So Treasury teams can start with a framework that supports the financing of planned projects through the issuance of green, social, or sustainability bonds, and adopt the use of proceeds approach, and then gradually building on from there. And implementing a sustainable finance framework is a really important first step to access the sustainable finance market and take advantage of some of the market interest and opportunities, which James from Moody's shared with us earlier on its trends and developments. And the top tips guide also explains the key benefits of having such a framework, which include, helping Treasury teams to make more informed financing decisions, better manage the associated risk, and also initiate dialogue with market participants on ESG, and potentially, have lower cost of capital as well. So ultimately, we believe that Treasury teams can really play a strategic role in steering the company towards a more resilient business model and in achieving its sustainability goals, as we have heard from the experience of Linda and Alex at Tesco. So both resources will be sent to you in the follow-up email after the webinar. So I'll just run a few more polls based on what we have heard today. So the first one is, how can you start considering environmental and social factors in your debt finance decisions? So some of the actions that you can see here were talked about by our speakers earlier. Great, thank you. So these are all good actions to take to get started. And then just another poll on what are the potential benefits of integrating environmental and social factors into debt financing or having a sustainable finance framework? Okay, these are all potential benefits apart from the third one. It should be a higher credit rating. So this is actually related to the fourth point. So when you start to consider and value environmental and social factors in your debt financing decisions, it actually leads to better risk management, which by demonstrating that the potential benefit is higher credit rating. So today, I think, we will all agree that our speakers gave us really, great practical examples on what implementing sustainability-linked financing can look like, and also, what are the latest developments and trends in the sustainable finance market. So now we would like to run a call for action poll, as we usually do at the end of each of our monthly webinars. So how will you translate what you have learned in this webinar to your work in the next 6 months? So quite a number of options there for you to think about. That's great. Okay, good to know. Many of you are going to take many of these actions over the next 6 months. Okay, so just to wrap up now, again, as I mentioned earlier, the two resources that I mentioned from A4S, we will be sending those to you in the follow-up email, along with other resources as well, to help you understand and also make a start on implementing sustainable financing. And these sustainability in action webinars are held monthly, and they will explore a different topic each month linked to our A4S essential guides. So in June, So next month we will have actually 2 webinars, one on CapEx on the 17th of June and one on managing future uncertainty on the 29th of June. And the registration link to these webinars will be in the follow-up email as well. And as we run similar webinars every month, we are very keen to get your feedback to help us make these as useful as possible. So there will be one final poll for you to complete to get your feedback, as you see on the screen. So please complete this as we draw to a close. And may I just take this opportunity again to thank you, our speakers, Linda, Alex, and James. Thank you for your time today, and also to each of you who have dialed in and for all your questions as well. And we hope to see you again soon. Thank you very much.
Thanks, everyone. Have a good day.